A very good morning to one and all. So today we are here for an next session of webinar on taxation of individuals in Singapore. On the taxation in Singapore, our webinar will be divided into four parts. Today being the first part, we'll discuss on taxation of individuals in Singapore. Next week, we'll be discussing on taxation of companies. And the following 2 weeks, we'll be looking specifically on the relief and rebates, what individuals would get and what companies would be eligible for the purpose of calculation of income tax in Singapore. So our presentation schema for the day, we'll be looking at what are taxable and non-taxable income, residential status, that becomes the most important priority for understanding whether an individual is a resident or a non-resident in Singapore, because the taxation calculation varies depending on the residential status. Of course, the tax rates, filing personal income tax returns, return filing date, and of course, consequences of non-filing. Certain deduction we'll be discussing today, but as I said, we'll be having a separate session for all the deduction for individuals and companies in two different sessions, much more in detail. And last but not the least, taxation of overseas income. So all income earned or derived from Singapore is chargeable to taxes in Singapore. Of course, there are two exemptions. One is overseas income, which is received in Singapore after certifying certain conditions, which we'll be looking at it at a later stage. And capital gain income is exempted from taxation in Singapore. So what is this income earned or derived in Singapore? It includes employment income. Employment income will also include salaries, bonuses, directors' fees, commissions, any other sorts of revenue which is given to the employee, gains from exercise of stock options which is given to the employees from the company, income received from overseas subject to certain conditions, pensions, retrenchment, and retirement benefits are also included as a part of income earned for which taxable comes into picture. Income from trade, business, profession, or vocation, and income from property investment in the form of rentals is also chargeable to taxation in Singapore. So, as we discussed, residential status becomes the primary condition to understand in which tax bracket a Singapore resident or non-resident is coming in for the purpose of taxation. So, if a person is a resident of Singapore, if he's a citizen of Singapore or a permanent resident in Singapore, of course, exempt for temporary absence is taken care of. And foreigners who have stayed and worked in Singapore for at least 183 days or more in the previous year. So if he's completed 183 days or more, he is considered a resident for the purpose of taxation in Singapore. For all other individuals who stayed for less than 183 days, will be considered as non-resident for the purpose of taxation in Singapore. Now, first, let's look at the tax rates if you're a resident in Singapore. Singapore's personal income tax rates for resident taxpayers are progressive in nature. So it starts from 0% for the first 20,000. For the next 10,000, which is the first $30,000, you'll be charged at 2% for the $10,000 over and above $20,000, and your tax payable will be $200. For the assessment year 2019, a personal tax rebate of 50% of tax payable up to a maximum of 200 is granted to tax residents. So when your tax payable is 400 and your amount of rebate will be 50% of that, maximum being 200 is a minimum, is a grant given as a tax rebate for the assessment year 2019. So tax rate starts at 0 and could reach 22% on a progressive basis for incomes in excess of 320,000 Singapore dollars. So now let's look at who are falling into the bracket of non-resident and how they are taxed. For those non-residents who are in Singapore and who's earned an income for less than 60 days, so let's take an example of a part-time lecturer or a vocational lecturer who's come from India to Singapore to take a course for 45 days. So if his income is less than 60 days in a year in Singapore, then that income is exempt from taxes. We also have situations where people have to come to Singapore and work more than 2 months, that is 61 days up to 182 days. Then he's considered as a non-resident and his income will be taxed at 15% or the progressive residence rate taxes, whichever is higher. So I'm just going back to the progressive rates and to understand what is this 15% bracket. So if a person is considered to be a non-resident and his income is anywhere between $20,000 to the extent of $160,000, so in this slabs, you can see that up to $160,000, your income tax ranges between 2 to 15%. But in the case of non-residents, irrespective of these slabs, up to $160,000, he will be charged at a higher rate, which is at 15%. And let's assume that his salary is $200,000. In the case of the $200,000, he'll be charged at a higher tax rate for that excess amount, to the tune of 18%, and it can go on up to 22%. So in the case of non-resident, unlike the case of resident, where its progressive tax rates will be from 0 to 22, in the case of a non-resident, it will be from 15 to 22%. So 15 being the bare minimum taxes what a non-resident will have to pay. So non-resident director fees, remuneration, consultation fees, and all other incomes other than the employment income are directly charged at a flat 22% in the case of non-resident Singapore's. Filing personal tax income, as you know, every eligible taxpayer's obligation is at the end of the year. There is a deadline in the following year where a tax filing has to be done. Tax filing can be done in two formats. One is the e-filing, which is newly introduced from the assessment year 2016, and a paper-based filing, which is also been there all these years. So on a paper-based filing, the deadline for filing income taxes for the previous year from Jan to December is on 15th of April. So anytime between Jan to 15th of April of the current year, an assessee can file the paper-based filing for the previous completed year for his income tax returns. In the case of e-filing, the date you have an excess 3 days as a grace. So your e-filing deadline is on 18th of April every year for the previous completed year. But it's not mandatory for everyone to file or every resident and non-resident to file an income tax return. It also depends on his income slabs. If his income is less than $22,000, unless otherwise instructed by IRAS, it is not mandatory for him or her to file the income tax return. So let's say a person's income is $15,000 per annum, then he or she need not file a paper-based or an e-filing tax return. However, he can do so voluntarily, but it's not mandatory. But if a person's income is $15,000 and he is mandated by IRAS by a writing notice that he or she has to file the return, so irrespective of his income, he will have to file the tax return for that particular assessment year. If your income is more than 22,000, and it's a mandatory tax filing, and there is filing has to be made within the deadlines and due dates. Of course, we know that when there is a deadline, there are also people who may miss the deadline, for which there are consequences from the IRAs. We look into the different types of consequences as we go on. But looking at the different types of tax forms, for a tax resident individual, the form is called Form B1. For self-employed, it's called Form B. And for non-resident, it's called Form M. Again, these are available both online as well as offline by paper-based filing. And steps is the deadline is being 15th for paper filing and 18th is for e-filing. After filing the returns, the assessee will get a notice of assessment or a tax bill, which we call, which will state his tax payable from IRS. Now, this tax notice can be received anytime between May to September of the current year for the income tax filed for the previous year. So as we have seen, the deadline is on 18th or 15th of April. So leaving aside the month of April, from May onwards up to September, every assessee would get either in his tax portal or by a letter from IRAS to his registered address, the amount of tax that he would be needing to pay for the previous completed tax year in the current year. And from the date of the letter or from the date of the announcement of the tax amount, the tax has to be paid within 30 days. In case the assessee has a disagreement with the tax amount calculated by IRAS, within 30 days, he or she will have to intimate IRAS either in person or in writing with the reasons for the disagreement in the income. So there are various consequences of non-filing of taxes. The first consequence is imposing a late filing fee not exceeding $1,000. So upon the non-filing, the tax assessing officer can imply a fee for a penalty, which can range anywhere between $100 to $1,000. Upon receiving the notice, the assessee will have to file the returns immediately and also file the late payment fees as instructed by the assessing officer. In certain cases, when the assessing officer finds that it is important for the taxpayer to be informed on his estimated tax income, they issue an estimated notice of assessment, and it may be based on his past incomes or past data records available with IRAS. Having that information submitted to the assessee will have to quickly and immediately go and make sure that he or she pays the amount as estimated in the notice of assessment. In the absence or the failure to do so, either for filing taxes or for paying the late filing fee or to go ahead and comply with the issued estimated notice of tax income, the assessee may be summoned to court. And when the summon to court has happened, it's mandatory for the assessee to go and visit the court and complete the procedure. So just to look at a broad overview of how taxable income is calculated and how net tax is calculated. First of all, we look into the total income of the SSE less expenses. Now these expenses are allowable expenses which are to earn that income. We'll look at that in detail in the next slides. That is what is called as we derive at a statutory income. From the statutory income, there are permissible donations which the SSE could have made, and those donations can be deducted from his statutory income to derive at the assessable income. From the assessable income, there is a list of personal reliefs which is available to a Singaporean resident or a non-resident taxpayer in Singapore, and those reliefs are deducted, and then we arrive at the taxable income. And taxable income at the respective slab progressive rates from 0 to 22, you will know exactly the tax payable amount. From the tax payable amount, there are few specific rebates which is given to a taxpayer in Singapore, subject to few conditions being satisfied, and those rebates can be deducted from the tax payable, and we will arrive at the net tax payable. And this net tax payable is the amount which is supposed to be paid by the SSE for the previous year in the current year, along with the deadline of the filing the return of tax assessment. To look at some of the exemptions which is available. So deduction for employees can claim expenses wholly and exclusively incurred only for earning that particular income. So as a part of his employment, if traveling expenses or subscription for professional updates are mandatory and he has done that, those expenses can be deducted from his salary income. For rental income, all those expenses solely for the purpose of renting out, for example, paying to the interest on property or property tax paid during the period, paying to a consultant or agent for finding a tenant for that particular property, all these expenses which are exclusively and solely related to that rental income can be deducted. An expense incurred during the period of tenancy as well can be deducted from the rental income to arrive at that net rental income, which will be treated as part of your net income. So having said that, there are multiple personal income tax relief which is available. However, whatever tax relief an SSE can claim, the maximum you can claim for a particular assessment here is Singapore dollars 80,000 as the maximum cap, which is being kept by the government. So next week, we'll be looking at incomes for companies, and the following 2 weeks, we'll be looking at specifically on the different types of reliefs and exemptions and rebates which is available to the SSE, being a company and being an individual. Overseas income is generally which is received in Singapore on or after 1st Jan 2014 is not taxable, and it need not be declared as well. This also includes income which is paid into the Singapore bank account of the individual SSE. However, this should be a pure foreign or overseas income which is being received. So let's say an SSE has some shares in a company in overseas, and that company is issuing a dividend declaration. So that dividend declaration which flows into Singapore into the account of the SSE, he or she need not be declaring that income because it's a total overseas income. To look into what overseas income will be taxable in Singapore, so there are a few conditions. The first is it's received through partnerships in Singapore. So a Singapore partner gets income from overseas because of his partnership in a Singapore company. So this income's main source is a Singapore partnership. So it will be treated as an income in Singapore and is taxable. Second condition is overseas employment, which is incidental to the Singapore employment. So let's say an SSE is a Singapore employee and he's been sent on a secondment basis on his job for a particular project in Singapore overseas to complete a task and come back. And if he's paid any income overseas, which is relating or incidental to his Singapore employment, he or she will be liable to taxes on that income as well. Employed overseas on behalf of the Singapore government is a straightforward case. You're representing the government of Singapore, so it's an income derived towards Singapore, so that will be taxed in Singapore. Trade or business overseas income, which is incidental to the Singapore trade. So you have traded something from Singapore because of which you're getting a foreign income, that is also taxable in Singapore. But if an income is taxable in both in overseas and in Singapore, then one can apply for the double taxation relief to avoid the double taxation. And as we know, 3 weeks back, Mr. Jugal Gala has taken a webinar on applying for tax residency certificate in this case, and that follows the double taxation avoidance agreement benefits that can be utilized as well. So looking at some of the tax rebates, one example of a tax rebate is a rebate which is given to tax residents to encourage them to have more children in Singapore. So to qualify, you must be a Singapore tax resident who's married, divorced, or widowed in the relevant year. And for every children they have from the year 2018, a rebate is given. So for the first child, a rebate of $5,000 is given on the total tax payable. For the second year, For the second child, you are given $10,000. For third child, $20,000, and for the fourth child, $20,000. And for every subsequent child, $20,000 per child is given as a tax rebate. And this can be claimed only in that particular assessment year, and it cannot be claimed every year. And this is also one of the ways Singapore government is trying to motivate its citizens and residents to have more children in Singapore. And this is a good sign what Singapore government is doing to encourage them to also have a means of livelihood in Singapore. Thank you so much. And I would like to give credits and acknowledgement to Vishwanath for preparing this wonderful presentation. So in the next 3 weeks, on every Thursday, we'll be looking at company taxes and also the relief for companies and relief for individuals. Thank you so much and have a good day. Looking forward to meet you in yet another webinar next Thursday.